Okay, I thought this was a great time to discuss the recent volatility in the stock market as it pertains to coronavirus, but also as it pertains to any and really most of the sudden headlines that can increase fear. None of my commentary is political or me trying to play medical expert or beat up the media. Please know that. It's a volatile time for the markets, but corrections are normal and they happen on average 1 to 2 times per year. In fact, you may remember a more recent December 2018 when markets fell around 19% past correction territory and almost into bear market territory, which is over a 20% drop. And what happened the following 6 weeks? A total rebound and then on to new highs. Now, no one is sure how long the market will react to this virus or how many infections or deaths will transpire over the coming weeks and months. But I will say that I've read no short of, probably 100 articles, blogs, commentaries from different experts, and the consensus seems to be that the reactions to the stats of coronavirus are overhyped. Who knows? And please don't get mad at me for saying that. I do sit on a panel of top advisors across the country, and one of the members left me a voicemail over the weekend saying, "David, do you realize that in 2002, the media reported a woman getting her arm bit by a shark in Hawaii and terrified anyone from getting near the water, and tourism suffered like crazy. Meanwhile, the same year, 39 people died from fallen coconuts in Hawaii and got zero media attention. And no one really actually died from a shark." So you get my point. My goal is to keep my clients and you and myself from overreacting. That isn't meant to downplay the seriousness of this virus, but we have been seeing how many more people die of the common flu every year. Take a look at this chart from First Trust. It tracks what happened to the market following different infectious diseases like SARS. The market dropped, then it moved higher with every single epidemic over the last 40 years. Every correction has its catalyst, and this one happens to be coronavirus. Now, I get this question a lot. Shouldn't I sell, go to cash, and wait it out, and then get back in the market when things settle down? Here's the problem with that. You'll likely get a head fake. Now, what is a head fake? It's thinking this is the bottom, and it's not really the bottom. So let's say you decided to sell now, and the stock market spikes 1,000 points on Monday, then another 500 points on Tuesday, and then another 300 on Wednesday. It's looking pretty good, and you decide to get back in, and then it drops right back down by 1,500 points the day you decide to reinvest. We just don't ever know when the bottom will be. We only know through hindsight. Anyone who tells you otherwise is taking a guess. That's the only way to know. An old wise saying that I heard by a mentor of mine in the business is time in the market is better than timing the market. If you are allocated properly to begin with, then you have already prepared to weather these types of storms. With our clients, we actually started adjusting their portfolios over a year ago, scaling back a few percentage points to risk each quarter. Not because we're market timers or we think we're super smart, but because we recognize that the likelihood of a pullback continued to increase as we hit the later stages of this bull market that really began after 2008. So what's my advice? Be prudent and patient and wait this thing out. Use this time to review your cash reserves in your emergency fund, and that's what I like to call bucket 1, and your backup reserves in your middle bucket, or your bucket 2. Now, do I personally think that the market response to coronavirus is over and we are in the clear? Well, my opinion is no better than any other professional when it comes to predicting an irrational short-term stock market, but I would say no. I do think airlines and travel will be affected in the short run, and some major companies will likely experience production shortages and therefore decrease potential earnings in the short term. And to the degree that consumers change their behavior, that means they may stop going out to eat, taking a vacation, canceling that business trip. And our GDP, our gross domestic product, is derived 68% from consumer spending. But keep this in mind, this could also be one of the greatest buying opportunities in recent times, right? And the best advice I've had for years during times of volatility like this still remains true. And that's turn off the TV, stop playing the outbreak or the upcoming election scenarios in your head, and go connect with someone that you love and care about. create memories and experiences, and utilize the only currency that really matters, and that is time. If you have any questions, give us a call. We would love to talk to you about this and help.